Many investors believe that there may be a way to predict when to buy and sell securities. In financial markets, mean reversion is the idea that higher than average returns will be followed by lower than average returns, and lower than average returns will be followed by higher than average returns. If investors were able to anticipate when the unusually high or low returns will end, they could sell or buy securities at advantageous times and earn higher returns. While this sounds fairly straightforward, one problem is that we're not sure what mean reversion should look like in the real world. For example, does the pattern take place over 3 years, or does it take 5 years or more to see evidence of mean reversion? Does the mean that we expect returns to revert to remain the same, or does it change over time? It's also not clear what the magnitude of the pattern should be. If the effect is relatively small, changing the composition of an investor's portfolio might not produce much of a benefit. A more pronounced effect might allow investors to anticipate when returns are likely to be negative. This would potentially allow investors to avoid periods of underperformance. Charts like these are simplified versions of what mean reversion might look like. The challenge is using real-world data to find evidence of these kinds of patterns. And this evidence must be strong enough to support a profitable trading strategy. It's not clear what mean reversion should look like, either in terms of timing or magnitude, so we have to do a lot of testing to evaluate possible trading strategies. So we took a large data set, 15 stock markets around the world, including the U.S. We looked at different premiums or return differences in those markets. These are the premiums associated with the market, with size, value, and profitability of companies. We tested several different trading rules on this data set. The moving average rules look to see if high average premiums tend to be followed by low average premiums. The runs-based rules look to see what happens after a premium has been positive for several years in a row. After running multiple rules, we ended up with 780 test results. But the number of tests causes a problem in itself. When you run a lot of tests, some of them are likely to show positive results just by random chance. Suppose we wanted to find someone who could reliably flip 10 heads in a row. If we asked 5,000 people to repeatedly flip a coin, we would expect about 5 of them to flip 10 heads in a row, simply by random chance. Just like our coin flipping experiment, some of our trading rules produce strongly positive returns, but that doesn't mean that they will continue to do so in the future. Let's look at our results. For each trading rule, we calculated an excess return, which is the extra return that the rule generated above a strategy that maintained a consistent focus on the premium. The majority of the excess returns were negative. Of the minority that were positive, many of these were fairly small. However, a small number of test results produced large excess returns. We believe that there may be a couple of things behind these positive results. The first is the fact that we ran so many tests. The second issue is that in several cases, the high return was due to a single year of data. And when results are due to a single year, it doesn't give us confidence that higher returns will persist into the future. So what can we conclude from this research? While we cannot rule out the existence of mean reversion, after looking at 780 tests, we just don't see evidence that mean reversion is strong enough to permit profitable trading strategies.